You cannot evaluate an investment decision based on its outcome. Take a second to let that sink in. If you buy an individual stock and double your money, you still made a bad decision. You had a good outcome, but you made a bad decision. Future stock returns are uncertain. When we are dealing with uncertainty, a good decision might lead to a bad outcome, and a bad decision might lead to a good outcome. Looking past outcomes to evaluate investment decisions is not easy for a human to grasp. We tend to have an illusion of control bias where we overestimate our influence on outcomes. This can be particularly dangerous when it comes to investing. I'm Ben Felix, Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you how to evaluate your investment decisions. There is always going to be an element of uncertainty that defines the ultimate outcome of any investment. That is something that we cannot control. We can control the quality of our investment decisions. If we can recognize the difference between a bad decision and a bad outcome, we may be better equipped to stick with a sensible long-term investing strategy, even when it is not producing a good outcome. It is very important to realize that making a good investment decision does not mean that you're going to get the outcome that you hope for. Think about your friend that doubled their money in weed stocks, or your cousin making a ton of money in Toronto real estate, while your index funds relatively boringly track the stock market. Evaluating a decision starts at the time that the decision is made, as opposed to when the outcome is known. Any decision is a risk. As investors, our decisions will result in us either making or losing money. To make a good decision, we need to know what risk we are taking, why we are taking it, and what the expected outcome is. Knowing those things will allow us to evaluate the decision in the future. When we talk about investing in index funds, we are talking about taking the risk of the market. People usually take on the risk of the market to achieve a financial goal. Market risk has an associated risk premium that we expect to earn. Let's go through that one more time. Taking on the risk of the market in order to earn the market risk premium to achieve a financial goal would be a sensible decision, regardless of the outcome. The market risk premium is well documented around the world as far back as we have data, and it is sensible that it will persist based on the way that capitalism functions. Going back to 1900, the global market has delivered a risk premium, that is, return in excess of risk-free assets, of 4.2%. This includes Russia's market going to zero in 1917 and China's in 1949. Making a decision based on an expected risk premium is perfectly reasonable. Knowing that the stock market delivers a positive risk premium over the long term might be helpful, but it does not make it much easier to evaluate your investment decisions in the short term. Even over 10-year periods, stocks have trailed bills 12% of the time in Canada, 15% of the time in the US, and 6% of the time in international developed markets going back as far as I have data available. There is a non-zero chance of living through a decade of flat or negative risk premiums for stocks. That does not make investing in stocks a bad decision, but it does leave a substantial amount of room for luck to influence the outcome. In his book, How Much Can I Spend in Retirement?, Wade Pfau pointed out that retirees in 1973 and 1975 had 28 of their 30 working years overlap, but the 1975 retiree reached retirement with 36% less wealth than the 1973 retiree. They both made the same investment decisions and worked for the same number of years, but their outcomes diverged based solely on the uncertainty of stock market outcomes. Similar thinking can be applied to small cap and value stocks. They have produced reliable long-term risk premiums. For example, US value stocks beat US growth stocks by 3.3% per year on average from 1928 through 2018. The same thing happened in Canada, where value beat growth by 2.59% per year on average from 1977 through 2018, and in international developed markets where value beat growth by 5.01% from 1975 through 2018. These are reliable risk premiums. However, for the past decade, owning US value stocks has resulted in a bad outcome, as value has trailed growth by 3.2% per year on average. Whether or not investing in value stocks was a bad decision depends on why the decision was made. Value stocks are riskier than growth stocks, and there is a return premium associated with that risk. Adding value stocks to a portfolio to capture an independent risk premium is not a bad decision, but that does not guarantee a good outcome. Now, to be fair to value stocks, if we looked at the returns of US value against growth in March 2000, we would find that value had trailed growth for the past 5, 10, 15, and 20-year periods. If we looked 1 year later, in March 2001, we would see that value had beaten growth for the past 5, 10, 15, and 20-year periods. Not only are we dealing with uncertain outcomes, but in order to increase the chances of achieving an expected outcome, it is crucial to stick with the strategy. This is what makes evaluating investment decisions so challenging. Investing in value stocks in 1980 was not a bad decision, but it resulted in 20 years of bad outcomes. And to finally get the good and expected outcome, you had to stick with it for 20 years of underperformance and hang on that one extra year. Probably an even better example of an investment decision that is hard to evaluate is owning individual stocks. The data on individual stocks is not promising. Most of the returns of the market come from relatively few stocks, and identifying those stocks ahead of time is impossible to do consistently. This makes picking individual stocks, on average, a losing bet. But there are still some people who will make money investing in individual stocks. Not a good decision, but it can lead to a good outcome, though a bad outcome is more likely. I think that this is particularly important when we are talking about index funds and being committed to index investing. It will always be possible to identify something, an active fund or an individual stock, that did better than an index fund. The problem for us investment decision makers is that when something does better than the index, that performance will be used as a tool to sell you on the strategy. A good outcome for an active fund does not make it a good fund. In their persistence scorecard, Standard & Poor's looks at US active mutual funds that have been top quartile funds for the past 5 years, and then tracks them to see how many stay top quartile for the next 5 years. In the March 2018 scorecard, only 2.33%, or 13 of the original 557 top quartile funds, remained top quartile. I think that I've established that evaluating investment decisions is hard to do, but basing decisions on persistent risk premiums and sticking with the decision for an investment lifetime is probably the best approach. We've also talked about the role of luck in outcomes, where bad luck can result in bad outcomes despite a good decision. One of the best ways to reduce the role of luck in your investment outcomes is through diversification. Earlier in the video, I mentioned that stocks in various markets can have 10-year periods of underperformance. When that happens in one market, it will not always happen in other markets at the same time. The lost decade in the US is a perfect example. From late 1999 through 2009, a Canadian investor would have lost money in US stocks. Canadian stocks, on the other hand, returned 6.47% per year on average over the same period. We could not have known ahead of time what those outcomes would be, but diversification reduced the impact of that uncertainty. Diversification is not limited to geographic regions either. I have mentioned persistent risk premiums as being sensible basis for investment decisions, even if they don't always pan out. The interesting thing about risk premiums is that they are not perfectly correlated with each other. When one doesn't pan out over a given time period, there's a good chance that another one will. This makes diversifying across risk factors an interesting proposition for any investor. Take our example of the lost decade in US stocks again. Over that same period, US small cap value stocks returned 6.45% per year on average. That is, US stocks as a whole lost value over the decade, but US small cap value stocks made a substantial return over the same period. We can take this one step further. Let's look at 4 US risk premiums: market, size, value, and profitability, and examine the 547 rolling 10-year periods from July 1963 through 2018. If we look for 10-year periods where one of the risk premiums was negative, that is, the market risk premium, the premium of small stocks over large stocks, the premium of value stocks over growth stocks, or the premium of stocks with robust profitability over stocks with weak profitability, there were 270, or 50% of the 10-year periods, where one of those risk premiums produced a bad outcome, meaning a negative premium. If we instead look for 10-year periods where 2 of the premiums were negative, we only find 43 of them, or 8% of the time. For 3 of the 4 premiums being negative, we find only 1 of the 547 10-year periods. This speaks to the importance of diversification not only geographically, but also across risk factors. It also speaks to the importance of almost blindly sticking with investment strategies, as weird as that feels to say, for an investment lifetime. If we have basis to make a decision today, it should take a massive weight of evidence to deem it a bad decision that needs to be amended. There's something called Bayesian thinking that I think it's worth mentioning at this point. In Bayesian thinking, we start with our prior assessment, known simply as a prior in Bayesian speak. The stronger the prior, the more overwhelming new evidence has to be to change our mind. In reality, anytime that we get new information, we have a tendency to weight it more heavily. This is called the availability heuristic. To apply Bayesian thinking, before drawing a conclusion from new information, such as value stocks underperforming for a decade, we have to consider it against the weight of our prior. In the case of value stocks, our view might change a little bit after a decade of underperformance, but not much, based on the strength of our prior. Any investment decision should be made based on the intention to take a specific risk, for a specific reason, with the view of achieving a goal. It is only on the quality of the process used to make the decision, not on the outcome, that the decision can be judged. Even with the best decisions, there is a chance of a bad outcome due to luck. The best way to reduce this chance is through diversification across both geographies and risk factors. How do you evaluate your investment decisions? Tell me about it in the comments. Thanks for watching. My name is Felix of PWL Capital, and this is Common Sense Investing. If you enjoyed this video, please share it with someone that you think could benefit from the information. Don't forget, if you've run out of Common Sense Investing videos to watch, you can tune into weekly episodes of the Rational Reminder podcast wherever you get your podcasts.